What's going on, guys, and welcome back to another video. So today, as over the last few weeks, we've been adding numerous companies and adjusting all 12 of my portfolio pies on trading 2-on-2, and today we'll be adding in the final two companies. One will be in the healthcare sector and the other is in communication services. Once we add these two companies in, I'll be happy with my diversification across all 12 of my portfolio sector pies on trading 2-on-2. But just before we get into that, if you're new around here, please consider subscribing to the channel, as we're just 46 subscribers away from our next big goal of 500 subscribers. And with that being said, let's dive right into my trading 2-on-2 portfolio. Let's start with my communication services company. So currently we have about €560 invested. That equates to about $700 or so, and we are up 11.5%. We currently have four companies in the form of Walt Disney, which is up 18.79%, Facebook, which is up just under 8%, and AT&T, which is currently up 1.88%. Now the fourth company here, Verizon, we added this in a couple of days ago, and I stated as well that over the last week or so, we haven't invested any further capital. What I've been doing is completing my pies, for example, adding in companies that I wanted to have into each of my portfolios, and to have 5 companies in each of my 12 portfolio sector pies. And once I have these 5 companies in, and after today, that will be completely 100% complete. And then next week, we're going to be adding in capital into these new companies. And next week also, we'll be dollar cost averaging in some of my original companies that I already hold, if any of them have went into the red, to improve my dollar cost averaging. Now, when deciding on a company to add into my communication services sector, it was kind of a toss-up between two, and they were Netflix and also Twitter. The reason behind this was that I find that Netflix is a brilliant company. However, at the current rate, I believe it could be a bit overvalued. So that was one of the reasons why I had to decide. And also the other company was Twitter. And the reason I decided to pick Netflix over Twitter is because I believe there's a lot more potential in the long term for Netflix, as I kind of believe Twitter is already at its peak. And like, even in my own personal opinion, I deleted my own Twitter about 2 years ago at this stage, and I do feel that over the next few years that Twitter will probably start to slow down in terms of user growth. So as a long-term kind of investor, I believe Netflix, although its current prices are quite high in my opinion, I still believe in the long term it's a better pick over Twitter. And also because the prices are quite high for Netflix at the moment, at the beginning I'm only going to be investing a small amount of capital into this company and kind of wait to see how it goes in terms of if it goes into the red or the green. And once it starts going into the red, I'll kind of start dollar cost averaging from there on in, again slowly dripping funds into this stock. So Netflix, as I presume you already know, is a provider of a subscription streaming entertainment services. The company has paid streaming memberships in over 190 countries, and it allows its members to watch a variety of TV, documentary and feature films across a wide variety of genres and languages. Netflix current CEO is Reed Hastings, and they currently have over 8,500 employees. They are headquartered in the US, and their sector is communication services, with their industry being broadcasting and cable TV. In terms of their financials, some key ratios: they have a market cap of over 215 billion, they have a PE ratio of 126.81, their revenue is currently over 20 billion with an earnings per share of $3.85. We can see here under financial summary that over the 9 months ending the 30th of September, Netflix revenues increased 25% to 18.35 billion, and also the revenues reflect the customer per average DVD US increase of 3% to $13.25. And we also can see here that Netflix income benefited from marketing decreased to 17%, and also their basic earnings per share excluding extraordinary items increased from $2.92 to $5. On the company's income statement and balance sheets, we can see the revenue again is over 20 billion with a net income of 1.87 billion. That gives a profit margin of 9.26%. They have total assets of nearly 34 billion with liabilities of 26, giving them a debt to assets of 77.68%. Netflix has ticker symbol NFLX, and over the last 12 months we can see that they've went up over 50%, or just under $170 per share. This time last year they were sitting at about $313, and they had a bit of a nosedive again in March to about just under the $300 mark, And I kind of found that quite interesting, considering that I thought more people would have even went down to about $295. But I thought because of the pandemic that a lot more people would have kind of stayed and subscribed even more in March. But obviously that kind of took effect after March, and we can see that over the last, let's say, 5, 6, 7 months, it has slowly went up in value and is currently sitting at $484.82 per share. By adding Netflix into my communication services pie, we now have Walt Disney, Facebook, AT&T, Verizon and Netflix, and we can see on the left, based on 5 years historic market performance, that we should be receiving on average an annual return of 14.72%. The second company that we're going to be adding in today is in the healthcare sector. Currently we have €588 invested, equating to about $700 or so, and we're up over 5%. We currently have 4 companies in the form of Johnson & Johnson, which is down 1%, AbbVie is up 21%, Pfizer is currently down 1.16%, and Abbott Laboratories is another one of the companies that I've added in over the last few days, so there is no capital invested into this company as of yet. The company that I'm adding into this sector will be Stryker, and it was kind of, again, a coin toss between, let's say, Biogen and also Boston Scientific, but I believe because of the financials with Stryker and also because they pay a dividend, that I went over Stryker instead of Biogen and Boston Scientific. So Stryker is a medical tech company. The company offers a range of medical technologies including orthopedic, medical, surgical, neurotechnology and spine products. Their current CEO is Kevin Lobo, and they have over 40,000 employees. They're in the healthcare sector, with their industry being medical equipment and supplies. In terms of some of their key ratios, they have a market cap of $87.5 billion, with a PE ratio of 33.62, revenue of $14.88 billion, and an earnings per share of $6.93. They pay a dividend yield of 0.99%, and again that dividend is quite small in comparison to some other companies, but because it's kind of in one of the more tech growth healthcare sector companies, this dividend isn't too bad. We can see here under financial summary, over the last 9 months ending 3rd September, the revenues decreased by 6% to $10.09 billion, and that's probably due to the pandemic as well. But we'll also look at their share price later on and see that that has been improving over the last 12 months. On Stryker's income statement and balance sheets, we can see again they have revenue of just under 15 billion with net income of 2 billion, giving a profit margin of just under 14%. Also on the balance sheet, they have total assets of 30 billion, liabilities of 17 billion, with a debt to assets of 57.5%. Stryker has ticker symbol SYK, and over the last 12 months it has gone up 15%, or about $30.50 per share. This time last year it was sitting at about $200, had a fairly bad nosedive in March because of the pandemic, down to about $127 a share. But since then, over the last 7 or 8 months, we can see it's gone up to $233 per share, and it has had quite an impressive increase considering it is a well-established blue chip company. By adding Stryker into my healthcare pie, we'll now have 5 holdings: Stryker, Abbott Laboratories, both companies I've yet to invest in, but they're added into the portfolio, and I'll start to invest into these next week. And we also have my 3 current holdings in the form of Pfizer, AbbVie and Johnson & Johnson. So again, on the left, based on 5 years historic market performance, on average we should be expecting roughly about 11.86% return annually. And by adding those 2 companies to my overall portfolio, we are now fully diversified across all 12 of my portfolio sector pies. In tomorrow's video, we do my weekly portfolio update on Trading 212, and tomorrow will be week 11. So in that video, be sure to stick around because we'll be going through each of my 12 portfolios to see how all my companies are doing in each of my portfolio pies. If you liked today's video, please consider smashing that like button, and as always, if you're new around here, please consider subscribing to the channel, as it really helps me out going forward. And finally, most importantly, if you have any comments, questions, suggestions or queries, please don't hesitate to comment below and I'll be sure to get back to you right away. Thanks very much guys, and I'll see you all in tomorrow's video.